everybody, and welcome to Beyond Death and Taxes, the podcast where we unpack the only two certainties in life, and we try to make one a whole lot easier to deal with. We're your hosts. I'm Clay. And I'm Matt, and we're part of the team here at Avalara. Every episode, we'll bring you insights on tax trends, regulatory shifts, and automation strategies that are shaping modern finance teams today.
Because while death may be inevitable, taxes as well. At Avalara, we're doing everything we can to ease the burden of tax compliance.
Hey there, and welcome back to Beyond Death and Taxes, the podcast where finance professionals get real about sales tax compliance without all the jargon or judgment.
I'm Clay.
And I'm Matt, and we're part of the team here at Avalara where we spend our days decoding tax complexity so that you don't have to.
And if you've been here with us since the beginning, thank you for coming along for the ride. We have already tackled some major ground. In our first episode, we broke down the key takeaways from Avalara's 2025 mid-year tax update.
And in episode 2, we went back to the basics with highlights from our Sales Tax 101 webinar. Whether you're brand new to compliance or just needed a refresher, that's one packed with foundational insight.
So if you missed either of those, now is a great time. Hit pause, queue them up, or circle back after this episode. You will be glad that you did.
But today we're digging into the weeds in the best way possible.
And that is talking about the trickiest states for sales tax returns. The one that confuses even the seasoned pros, the one with the most inconsistent rules, surprising deadlines, or just downright strange formatting.
And we've got highlights from one of the most downloaded webinars on this topic, the 10 trickiest states for sales tax returns. If you've ever looked into filing and thought, why is this one so weird? Then this episode is for you.
But first, you know what time it is. Welcome to the Compliance Graveyard, where we say a few words for outdated tax practices that really should have been buried years ago.
And today, we're laying to rest the belief that all states handle sales tax the same way. Because if you filed in more than 2 states, you already know that is absolutely not the case.
We're talking different rules, different deadlines, different formats. Oftentimes, different definitions of what's even taxable.
So let's go ahead and bury that myth, Clay. Sales tax compliance is certainly not uniform, and pretending it is, that's how mistakes happen.
Cookie cutter thinking, to you I say rest in peace. You're no match for today's multi-state complexity.
All right, now that we've officially buried that outdated mindset, it's time to dig into what makes these 10 states so tricky when it comes to sales tax returns.
And to do that, we're handing it over to Avalara's tax experts. They're going to do a deep dive into the states that trip up even the most experienced teams. You'll hear what makes them complex, you'll hear what to watch out for, and how to stay ahead of the curve.
Let's get into the highlights from the 10 tricky states for sales tax returns.
Nexus is your connection with a state, which requires you to collect and remit sales tax. This is usually triggered when you meet some sort of tax threshold. So as simple as that, we'll make it more complicated. Nexus laws vary by state, and some states have been very creative in developing some nexus laws that businesses decipher and follow. Traditionally, nexus was all about your physical presence, but the explosion of e-commerce has driven many states to seek new ways to establish this nexus. Traditionally, these would be established from a physical presence in a state, you have an employee there, where you store your inventory, where you sell, and where you might attend a conference even. Over the last few years, you've probably heard of a thing called Wayfair, the Wayfair decision, which really put the stamp on economic nexus and this new form of determining your obligation to remit and collect. Economic nexus impacts businesses who might have no physical presence whatsoever in a state. We refer to you lovingly as remote sellers. Your goods and services in that state meet or exceed the state's economic nexus threshold, which may be different from physical presence. To make matters more fun, some states allow remote seller registration to leverage a flat or simplified rate. So if you are a remote seller and you've established nexus in a particular jurisdiction, check out and see if you get a different or easier way to manage that. Lastly, we'll talk about marketplace a bit here. If you sell online, like Amazon, Etsy, Walmart, then you need to understand a set of sales tax regulations that focus on those marketplace sales. Those are referred to as marketplace facilitator laws. These impose an obligation on the platform that facilitates the sale. So the platform or the facilitator collects and remits sales on behalf of your business and the seller. These three areas or nexus flavors are significant because they shift your obligation to collect and remit from the seller to marketplace platform or directly to the state. So on screen, we're showing real quick a heat map. This is our economic heat map, and this is actually what you would see in your Avalara portal if you're an active customer. In fact, this tool is right on the homepage, and it's designed to help you keep a beat on where you might be hitting some of these wacky thresholds. Sarah, I've got to ask, because last week you were at our Crush event, which is our user conference in Austin, Texas, and I think this was a big topic with our active customers, right?
Yeah, it is a hot topic, and it is reliant on the integrity of the data. So as long as we have as long as we have the accurate data, then you can use it as a tool. But it's not something to say like, this is 100% where you need to register. You still need to do research and understand if you are actually obligated to file in these jurisdictions. So the intention of this heat map was intended to be a tool, not necessarily like this is 100% guarantee where you need to register. So I think that's important to call out.
Let's talk about what's been happening now. It's 6 years since the Supreme Court decision, which makes me feel old. In the world of online sales, Wayfair has really come full circle. And here's what's happened. So the Supreme Court decision, South Dakota versus Wayfair in 2018, before that decision, states could require a business to collect sales tax only if they had physical connection to the state. This decision changed things, and it enabled states to tax or require nexus from a business without it. So as soon as that decision was final, states fell all over themselves to adopt economic nexus rules, and very quickly. And when they started, they looked at South Dakota and they said, okay, here's the precedent that's been set. We're going to follow their lead because we know it's going to work. And they typically defaulted to $100,000 in annual sales or 200 transactions in the state from current or previous calendar year. Boom, triggered. You have Nexus. You now have an obligation to register, remit, and file. It didn't take long for some states, though, to realize that these thresholds didn't make sense. So real quickly, we go from something maybe a bit harmonized to the way sales tax goes in this country anyway, which is pretty all over the map. Economic nexus is still making headlines. California was the first state to realize the threshold wasn't the best fit especially with for a state with one of the largest economies, and they've made changes. In fact, as of October of last year, roughly 20 states have already adjusted their economic nexus thresholds in some way, and 10 states have actually dropped the threshold for transactions altogether. So let's look at some recent examples here, and let's make things real fun and show you how complicated it really looks. In fact, the landscape is pretty dynamic and tricky. So here's a complete picture. You can see here every state has some sort of different idea of creating that nexus for you. And so you need to ask yourself often, is it a transaction threshold that I need to be monitoring? Is it my sales? Are exempt sales included or not? And it's not Wednesday, but I would be remiss if I didn't drop a Wacky Tax Wednesday story. Did you know that Alaska, who does not actually have a sales tax, a state sales tax, has their local governments got together and adopted economic nexus laws. So if you meet the threshold in a local Alaska jurisdiction sale, you are going to be required to file as an Alaska remote seller to collect and remit. That is absolutely wacky. Lastly, one more thing before we get into the fun of returns, exempt sales. Yes, even if your sales are exempt, you may still reach economic nexus thresholds and have an obligation to file. Many states' laws include exempt sales and services in their threshold counts, whether it's gross or in your counts. You might remit $0 in sales, but you must show that the sales you must show the sales on the return, and even demonstrate proof of your exemption certificates. So exemption sales, they may be exempt from your day-to-day, but they absolutely matter to the states. Keep an eye on those.
So 4 common challenges. Best practice number 1, stay on top of regulatory changes and evolving requirements. We all know that this is super important. Staying current on statutory changes across each jurisdiction is daunting, and it's one of the biggest challenges that we have, and one of the biggest challenges for every business that has different requirements, right? So we aim to, we at Avalara have a whole entire content team and a whole entire statutory regulation team that stays on top of these. But internally, if you're doing this, it can be very daunting. So we want to make sure that if there's a way that we can support our customers and support people that are maybe not even our customers yet, this is one of our main goals. There's 13,000 different tax rates in the United States, so it can be very cumbersome for our customers, and so we want to make sure that this is something that's top of mind for everybody. And then there's not only just regulatory changes, but there's also sales tax threshold triggers. There's all kinds of things that go into this best practice number 1. So we want to make sure we're always reminding folks of how important this is. And so that's best practice number 1. I was going to try to breeze through these a little bit quickly just so that we can get to the top 10. And so Matt touched on marketplaces a bit and economic nexus. So it kind of went hand in hand when all this was rolled out. And I'm sure that most people on this call are already aware of this. But marketplaces, gosh, look at the states. Most of them have marketplace facilitator rules. So there are about 4 states that do not have the marketplace facilitator rules. Every other state has it. So whether you're a seller or a facilitator in a marketplace, there are requirements for reporting, and that's what my teams do, and Matt's teams do. We file the returns, and so we have tools that help us report the sales where necessary, and then also make sure that we're staying on top of those regulatory requirements. So just wanted to breeze through that quickly because I think Matt touched on it a little bit. And then best practice number 2, managing returns deadlines. Who loves this? The 20th is our biggest deadline, and we have returns that are due before and after, but the majority is the 20th. And so if you are in the world of sales tax, you know that is a deadline that we plan our worlds around. And so it's really important to stay on top of these requirements. And when you reach certain thresholds, which is great for your business, but you all of a sudden have a higher filing frequency, and we need to make sure that we're staying on top of those. And you know what? Like, there are certain states that actually have different due dates based on the date of the return and the payment. So, like, those are all different things, and we manage them internally based on like some companies. I'm sure everybody uses Excel because we all love Excel. But there are different deadlines based on, the different requirements by the state, electronic filing frequency, all these different things. So that's like definitely one of the main things that we have to focus on, because you will incur P&I if you don't. And there are prepayment requirements, and then there's also timely filing discounts, which you want to take advantage of. And our company at Avalara, we don't want to ever miss out on timely filing discounts. So we never consider that. We always meet those deadlines to make sure that people can save that money and get that money back. Third best practice, aggregating tax data. We need to make sure that the data is all in, however it's consumed, whether it's a connector, whether it's a Excel file. We have lots of different options to import your data. We want to make sure that your data is accurate so that when we file, there are certain returns that I'm sure most people on this call know have monthly prepayments versus quarterly returns versus annual reconciliation returns. And we need to make sure we have the integrity of the data to make sure that multiple reasons we're maintaining those thresholds and we can help keep up with those prepayment requirements or increased frequencies and things like that. So we are always working with our customers on how to aggregate tax data. If you don't have a connector or an API, then you're importing data maybe. And we're always working with customers to make that as simplified as possible.
I have to interrupt, Sarah, because this, usually it's the point where I'm like, okay, I'm watching the rules. I'm aggregating my data and I'm looking at due dates and all that stuff. And I want to march right into it. But there's a couple other things, right? But this is normally the part where I'm let's go, let's get it done. And there's a not so fast moment that we usually hit. And that's on that last minute, right when we're filing.
Very true. So we do have timelines in place because of the fact that the deadlines are so upcoming. They're so fast. A lot of times we see companies that have an issue with, the end of the month reconciliations and then also getting the data into our system. And so it can feel time consuming or just fast paced, I guess, to get all that data in. And when we do that, the reason we have to do that is because of the fact that we have this full service offer here, where we fund and pay. And so those two things coupled, which is actually different if you think about the income tax world. You don't always have to fund and pay together. So it's different. You have to fund and pay these returns at the same time. And so that's a great thing that is great, but also sometimes difficult we've seen for clients because of the timing of different departments and the ability to get that data in as fast as possible. So, it can be time consuming and it can be, a bit stressful at times, but our goal is to always fund and remit timely. And so we want to get those discounts for our customers. We want to do these things. And so I think that's a really good point because that's super important to us. And I think this last one, the last one was managing returns filing. So we talked about earlier, thousands of jurisdictions. We've got lots of forms, filing and payment options. We want to make sure that your historical data is in. We want to make sure we get your returns accurate. We want to make sure that they're filed on time. We want to make sure we get those filing discounts on time. And get that money back to you, because that's actually money back to our customers. And so we really work hard to do that. And we don't miss that, by the way. Those are our deadlines. So it's pretty cool. And then when you're onboarding with if you're if you're a new customer, when you're onboarding, we talk through that and we make sure that's a expectation.
Yeah, there's no right or wrong, is there? If you got a tricky state, it's a tricky state. But we do have some fun ones that we've picked to talk about today. You want to wait a minute, Courtney, and see what folks sound off on before we go right in? I can already start talking to it.
Dive in.
Yeah. Yeah. Well, here's a table set, right? This year, Sarah and I and our teams, we're going to file millions of tax returns, millions plural. So these 10 states, we're no stranger to them, and yet they are still the jurisdictions that bring us the most fun. I use fun in quotation marks. So let's remember, across 50 states, there's thousands of tax jurisdictions. Any business selling within or into the U.S. may be required to file a sales and use tax return in one or multiple states. Some states' tax requirements are trickier than others. And the more familiar you are with these complex guys and the unusual states, then the more likely you are to be compliant. So we're going to show you a map here, and I'll orient you to what's going on. What you see are dark blue states, and you know what? There's no state names on here, so bonus points if you can name these off without cheating. The dark blue are our top 10 tricky states. We're going to get to that in a second. We wanted to call out our big four. That would be Florida, Texas, New York, and California. So these are the states with the highest populations and the highest sales tax revenue collections. These states are typically on the tip of the spear with trending. So we keep our eye on these prizes to see how the other states might follow suit. They happen to be in our top 10 most complex as well. But in addition to these big four and the tricky 10, we couldn't resist to have some honorable mentions. And if you love college sports, these are the guys who are right on the fringe of your top list. So Alabama and Kansas, they have unique sales tax laws that can affect the complexity of your return. Both of them require prepayments. And they have separate returns for individual sales tax. And as home rule state, specifically for Alabama, they have local sales tax requirements as well. South Dakota it was a trendsetter with the Wayfair decision. With Nexus, filing return can be a real headache when it comes to file. Sorry. Our friends in South Dakota are great. South Dakota's Nexus threshold is based on gross receipts and taxes everything, even generally exempt customers like nonprofits and religious organizations, taking that into mind. And lastly, our honorable mention, New Mexico, where they have gross receipt tax and complex tax form and returns processes that look different from some of the other states. Some goods are taxed at 6% on everything and 3% for groceries. New Mexico has a 50% deduction from gross receipts for the cost of groceries. So do you have the ability to classify and signal these on your return? So the difference in wording just slightly can make this state a little complex and challenging, especially with those who aren't in the know or working with New Mexico returns all the time. All right, Sarah. So let's talk a bit about our fun 10 here. We're going to start with these four right here.
Okay. All right. This is where I get to geek out a little bit. So I'm excited. Arizona, I think a lot of folks already understand the issues with Arizona. It depends on your registration and depends on how you're selling into Arizona. Are you marketplace? Are you selling in a marketplace? Are you a remote seller? Depends on how you're registered. And then it also depends on what you're selling. So there's business codes. Like, it's one of the most complex returns because you have to understand, are you selling just retail? Are you selling consumer's use? Are you selling are you reporting consumer use, I should say? And all of these things. So it honestly, with all of the different codes that you have to follow, and there's a giant list, it can be cumbersome.
Tell me about these codes, Sarah. Are they state imposed, or
yes,
are these site codes
state
for yourself? Okay, and they
Yeah.
do what on the return? They tell you, they tell the state what?
Well, one, it depends on how you're registered. You have to have the right code for how you're registered. So if you're a remote seller, you have to have the right codes.
Hmm.
And then also you have to report deductions. You have to report your city, local, state has to match. Like all of these things have to match in different areas on the return.
Hmm.
We have super simple returns in like areas of like Rhode Island where it's like one jurisdiction or it's like one rate. Um, no worries there, right? So Arizona is very complex return to fill out. And if you don't understand the registration requirements and how your business operates in Arizona, then that leads to complications. Our teams do a lot of work up front to make sure that people are registered correctly and according to their business and to make sure that we are reporting the correct codes. Because if you don't, then you're going to receive a notice immediately. So California, where I live, is one of the most complex states. It's one of those states that it's due at the end of the month every quarter. California also has a monthly and a prepayment, or a monthly prepayment plus a quarterly return for anyone over a threshold. And there's separate schedules, Schedule A, B, C, and that's district, county, and then location reporting. Location reporting always adds like another fun bag to the list. My son said it is the Sigma last night. So for anyone that understands that, because California's, in my mind, pretty cool other than the sales tax return. And it's probably the only one I learned in college because of being born and raised in California. But it has its own complexities and you have location reporting there as well.
What does that mean, location reporting? Do I need to register those?
Yes. Every location that you actually have a physical location for, you need to register. And then there's also the idea of whether or not you need to schedule or have a Schedule A or B and C. So if you're out of state, you don't have to have the location reporting, but if you're you only have to have the Schedule B. But if you're in state, you need to consider origin versus destination address because there could be a different county versus a different city that you're reporting to. It's very confusing.
It's an alphabet soup.
Yes. Colorado, I think most people understand the issues with Colorado. I don't even know where to begin with this one. There's physical versus non-physical locations, and what one thing that we've done and we spent a lot of time on here in our company is figuring out a way to automate how to register all of our companies for non-physical locations and make that easy on our customers. Colorado has been gracious enough to allow us to not report where sales are not being reported. So even though we register everybody for all non-physical locations, we don't always have to report them if there's no sales being made. So, but that's for non-physical. Anything that's actually a physical location, you have to report in.
Oh, Sarah, what is a non-physical location? I mean, that sounds cerebral.
That's a good question. Non-physical location is in certain states, and we have what comes to mind is Colorado, Illinois, Missouri. The term has been deemed as non-physical location, but it really means a destination-based reporting. Honestly, like it's because the returns were historically location-based. I think that when kind of some of the changes happened with Wayfair and with other things, this idea was introduced for physical versus non-physical locations for destination-based reporting. really.
Got it.
Is what it is. And so, Colorado has that, and it's one of honestly one of our most difficult returns. Um, and so that's always complex. Florida, it's, a little bit less complex when it comes to these other three states I just mentioned. They have prepayment requirements. Once you meet a certain threshold, you have to file prepayments, and there are three different ways to file them. You have to understand those different methods, and you get to choose. That's a great thing, on how you're going to report them. But if once you meet a certain threshold in states that require prepayments, you are subject to P&I if you don't make a prepayment. So, based on the fact that you met a threshold and now you're required to have a prepayment, now you're subject to P&I if you don't make the prepayment. So you have to stay on top of that. And, they send out, the states generally send out, notifications and stuff like that. So you should be aware of it. But if you don't make it, you're subject to that P&I, which is always generally 10% of tax liability. So,
what is surtax? Do you know what the Florida surtax is? Or these I keep seeing this pop up.
Yeah, Florida surtax is more like a they call it surtax, but it's more like a local tax that is imposed, and you have to make sure that you're reporting correctly in this correct jurisdictions.
Got it.
So or like the correct rate.
That's right. Yeah. Yeah. Oh, fun. Let's move on.
Mm-hmm. Yeah. So Illinois, I feel like I could go on forever about Illinois. Also has the physical and non-physical locations. And has really, and there are changes coming actually in January, where there was a matrix basically based on how your business runs in Illinois. And once that, change happens in January, I think it's January, once those changes come out, we'll see what happens with how we're going to handle that internally. But there's the same idea of physical versus non-physical location based on destination based. And these are like states where you have to consider where the transactions are coming from, whether it's in state or out of state. And you have to make sure transactions are correct. Illinois also has weekly prepayments.
Did you say weekly?
Weekly, yes.
Oh, goodness. So 52 weeks. So, no breaks.
So based no relief, on your threshold, yes, you have to file weekly prepayments, and some of them are as early as like the 7th of the month. So those are not always easy for customers to manage. So we do manage those internally, but then I guess Louisiana, moving on to Louisiana, we've got the home rule versus the RSR, which is the remote seller return.
There's a lot of different flavors of what kind of seller you are in Louisiana, right? I think there were 2 or 3. You help me remember those.
Yeah, so
remote seller.
Go
ahead.
Yeah, there's there's 3 different flavors. There is the state return, and then there's home rule states, which I probably forgot to mention. Colorado is also a home rule state, so if you have locals in Colorado, you should also look into that. If you have physical nexus there, Louisiana is the same way. You have to understand if you have physical nexus, and then also if you're a remote seller, or if you're, I think the other one is called a market, direct seller. And so there's 3 different ways you need to look into that and make sure that you're registered correctly and then filing correctly. Missouri also has a non-physical versus physical. So the 3 that I mentioned so far are Colorado, Illinois, Missouri, and those are the ones that have those physical and non-physical locations. And we worked really hard to make sure that we can help our customers internally not have to deal with the registration of those non-physical locations, because it's more like a direct sell into a location. So we've done a good job there, and continue to evolve with those states.
One thing, I don't know if this is appropriate for all who have an obligation for Missouri, but there's these site codes, these jurisdiction codes that I believe are state imposed, state created, right? That you need to have as a business and apply to your return. Is that right?
Yep. You have to have the site codes.
And so what do? I go into the portal and I have to retrieve them and then I have to put them in my return?
Well, we have multiple ways that we handle these. So Colorado, we have a very automated way. Missouri and Illinois, we have agreements with them where we are able to pull that information directly from
So we
the
can
state.
do that for a business, but that you've got to do that manually on your own side if not, right?
Yeah, if you're not working with us directly for the file these returns, you might have to go to the state or you might have to register them.
Yeah.
On the website.
And these get created as I sell in different places, which is not fun.
Yeah.
So you got to really love the bookmark for the Missouri Department of Revenue site.
Yes. Yeah, that's a big one because Colorado's 760 jurisdictions, I think. Missouri is about 3,000.
Oof.
Yeah, so it's a pretty big deal. And then New York, New York likes to have their own quarter, which is fun.
Oh yeah. Yeah, and that's a great PSA, everybody. Q3 for New York is next month. They're due.
So we have our own special quarter, every New York quarterly return. I honestly think it's rare that we see customers that don't file the monthly and quarterly these days because of the threshold. But if you file the monthly and quarterly, you know that the quarterly return is due at a different quarter than every other return that we file. And in addition to that, once you meet a certain threshold, you have to file the prompt tax. And that's an additional flavor to the mix of.
Is it okay for me to say that's a fancy word for a prepayment? I mean, is that what that is? What is a prompt tax?
It's a prepayment because it is deducted from the return, the quarterly return, but it's a little bit complicated or a little bit complex because you're just constantly not like it's hard to keep track of sometimes, I guess, when it's not on the same quarter as everybody else, right?
Sure.
So you've got to make sure that you're tracking that. So.
All right. Yep. New York coming up next month. The 2T states.
The 2T states. So Tennessee, anyone that's filed Tennessee understands the complexities there. There's outlet reporting, which is location reporting. That's our internal term is outlet reporting. And so you have to file location reporting, and then you also have to make sure that you're looking out for that single article tax, which is fun.
What's that?
And reporting that correctly.
Single article tax. What's that mean?
It's just a certain volume of tax that is in certain guidelines that has to be reported separately on the Tennessee return. Gotcha. Yeah, and so as long as we are doing that correctly, they also have deduction breakouts and there's so however many locations you have in Tennessee, they all have to be reported on the same return. So do out of state locations, and so it can be a very complex return to file. And then Texas, I mean, don't mess with Texas, right?
Mess with taxes? Oh, Texas. Sorry.
Yeah, also has outlet reporting, and then also has the origin versus destination based. Generally, most taxes raise up to the 8.25%, but they, depending on where the sale originated, will actually affect the return. So, you have to make sure you're paying attention to that. And also, I mean, taxes will come down to your business if you're ever late. But there's one good thing that is really cool that I was excited to call out at Crush last year or last week, is there's a prepayment option. Once you meet a certain threshold, there's a prepayment option that a lot of our team or our customers don't take advantage of. That if you meet a certain threshold, you can make a prepayment and you can actually save your company some more money.
If I could wrap, Courtney, I'd say know your nexus, understand those flavors and what that means to your business. If it feels daunting, if it feels like a heavy lift, consider tax research. Consider whether it's through us or a firm to help you get that strategy in tech. Understand where you're filing, when they're due, and the unique requirements of those returns. Budget time for that if you're doing it in-house. Find a way to aggregate your data. If you're not using a centralized engine for to house all of that, then what are the reports that you can marry together so that you have a good source of what your ship to, ship from, and sales tax collected storyline is, so that makes it easier to remit. And lastly, if you got to keep an eye on the news and all those rates and changes that are happening.
And that wraps up another episode of Beyond Death and Taxes. Thanks for joining us as we have navigated the quirks, complexities, and curveballs of sales tax returns across tricky states.
From filing deadlines to formatting oddities, if it feels harder than it should be, it probably is. But you don't have to handle it alone.
If today's episode helped you breathe a little bit easier, be sure to follow or subscribe. We've got more compliance insights, expert tips, and of course, more outdated tax myths to bury.
And you can find the full 10 Tricky States webinar and more helpful tools at Avalara.com, or just check out the link in the episode notes.
We'll see you next time right here on Beyond Death and Taxes.